Okay, people, we'll get it underway. Welcome to this Leading Sheep webinar, Wool, Lamb and Sheep Markets, What to Expect. I am Noel Dempsey. I'm the Regional Coordinator for our South Region Consultative Committee. With us, we have Aaron Phillip. Aaron's the Extension Officer with the DPI in Charleville. His phone number, if anything goes wrong, is 0400 256 427. So if you run into a technical problem, ring Aaron, not me. Also with us, we have the Extension Officer with the DPI in Longreach, Zoe Sibley. Zoe will be taking some notes, and you may see some of those in Facebook posts and other things in the near future. And most important, we have Ethan Woolley. Ethan's the Insights Coordinator for Mecardo. Mecardo is a free service via email of Nutrien, and I subscribe to it, and I have since the bad old days where you had to pay. We have apologies tonight for those that have read our advertisements. Robert Herman, who is the Executive Director of the National Council of Wool Selling Brokers, has had to cancel for personal reasons, but he assures me he has briefed Ethan totally. We will run to approximately 8:40. We will allow plenty of time for questions. At the end, you will get three options for you to let us know what you're thinking, either about the webinar or events that Leading Sheep can hold, or whatever springs to mind. You will get the ability to respond immediately or by email probably tomorrow, or you can scan the QR code for those that are technically competent, which means that I won't be using the QR code. Please take a couple of minutes to share your opinions. We do value and we do use your feedback. We welcome questions, and we have allowed plenty of time for them. If you want to ask a question, at the top of your screen, you will see raise, which is raise your hand. You can type, that notifies us that you have a question, or you can use the chat box, or Aaron, fill me in here, it's Messenger, is it?
The Q&A section.
Q&A. We haven't been able to find it on my computer yet. To cut down on background noise, you will be muted until you raise your hand and ask a question. Finally, before introducing Ethan, I'd like to let you know that Leading Sheep is funded by AWI and the Queensland DPI and is supported by AgForce in this state. So without further ado, we'll get straight into the webinar. Ethan, if you want to take control. Thank you.
Thanks, Noel. Thanks for the invitation to present today as I begin sharing my screen. There we go. That should be showing up. Perfect. So, g'day everyone. My name's Ethan Woolley, and as Noel said, I Market Insights lead with Nutrien Ag Solutions and editor and contributor to Mecardo. So for those that aren't sure what Mecardo is, I'll explain in a second. But today I'm here to talk a bit about what's happening in sheep, lamb and wool markets and the broader global economy. So at Mecardo, what we do is we focus really strongly on being data-driven when it comes to news and trends and information about the market. We provide bespoke analysis and frequently provide articles about the market, particularly beef, sheep and lamb, grain and oil seeds, wool and other fibers. And our key focus is determining what happened, why did it happen, and what does it mean. So our team of analysts have all economics backgrounds and for the most part, are on farm. So a lot of the questions that they have about the market that they're answering are questions that most of their neighbours and people in the community have as well about the market. So fundamentally, what we want to focus on is being data driven. So we tend to focus on what's been happening, and as well as focusing on little things here in Australia, those big picture economic drivers that we see as well. So I'll take you through the big economic drivers first, take you then through the lamb and sheep markets, and then onto wool. And then we'll have time for questions at the end as discussed. But yeah, keen to get through it. Before I get to anything else, you're going to hear this a lot. Export demand is the key to growth for Australian agriculture, and it continues to be the underlying driver of a lot of the recent pricing and supply and demand factors that we're seeing in lamb and sheep markets in particular, but also in wool markets as we've seen over the last 20 years. Exports are fundamental to our existence. And these two charts, I think, really summarise the impact that it's had on Australia, as well as what the future could look like. So this chart here, the forecasted global middle class consumption share, that essentially shows us that at the beginning of the century, the USA, the EU, Japan, they were established big economies. They were the ones buying with the most middle class people, spending money on what things middle class people do, which is higher quality food and imported products from other countries. What we're going to see as we move towards 2050 is that a bigger share of that middle class consumption is coming from places like China, India, and Southeast Asia, like the Philippines, Malaysia, Vietnam, countries like this. So what this means is that the USA, Japan, and the EU, they're not going to go away in terms of consuming products such as Australian red meat, but in fact, there's going to be more participants in that market looking to buy our product, and that will drive prices up higher in the long run, and also demand for volume. So we've seen that already in terms of exports in the Australian lamb market. From 2000 all the way up to last year, seen significant growth, and that's been driven by increasing export demand from different countries than we were trading with historically. We're also going to see a lot of focus on free trade deals and other things that are focused on getting Australian products into other countries. Another critical piece of market movement at the moment is the impact of inflation. Everything from its impact on the cost of living, retail demand, and operating costs are all impacting the supply chain one way or another. So you've all seen that when you go to the supermarket, you'll see that a lot of the serving sizes are smaller than they were 2 or 3 years ago. And there's a lot of management of consumers' behaviour. So they want to make sure that they're still capturing some consumers buying red meat, but to make sure they keep that share of wallet, they're reducing portion sizes. This is just an example of a number of different things happening in the economy that are impacted by inflation. We're seeing interest rate rises, we're seeing capital costs increase, and we're seeing stagnant economic real GDP growth. So that's what these two charts essentially demonstrate. The consumer price index, of course, inflation rate, continue to increase here in Australia, above that target rate of 2 to 3%, and the advanced economies in the world, so the US, Australia, all those countries in Europe, China, all these advanced economies, they're not really growing as strongly as they previously have done because we're still recovering from COVID and from this period of economic uncertainty, which I'll get to shortly. Another key factor that's going to impact every market, not just lamb, sheep, and wool, is the rising Aussie dollar. So over the last couple of years, the Aussie dollar has been pretty consistent, not that volatile, and that's meant that Australia, the weak Australian dollar has meant a lot of people that buy products from Australia have done so willingly, and that's a really important thing for an industry such as agriculture, which relies heavily on exports. This year, though, we've seen a pretty rapid rally in the Australian dollar. That's been driven by a lot of uncertainty in the US for investment and the rising interest rates we're seeing here as well. Now, what that means is a stronger Aussie dollar reduces export competitiveness, but on balance, should make imported goods more affordable, such as inputs that you would typically see coming in for agriculture. We also see that cotton and crossbred wool have strong negative correlation to a rising Aussie dollar, but some other commodities don't have a strong negative correlation. So that essentially meaning when the interest rates go up, the prices of those products go down. So there's always going to be different impacts of currency, but fundamentally, things that were cheap to buy from Australia a year or two ago for that same volume are now going to cost more, whether the price of that underlying commodity has gone up or down. And that impacts our willingness of our trade partners to buy our products. No matter what side of politics you might stand and whether or not the policy decisions made by the US government are good or bad for the US, fundamentally, the amount of change that US politics is going through creates significant amounts of uncertainty and volatility that impacts everyone in the market. So what this chart shows is the number of executive orders made by the president by number of days into the presidency. So as you can see, Trump, by his own standards, is making a significantly higher amount of policy interventions and decisions, many of which are based on creating or changing tariffs than he previously has done before. So when we think about the global marketplace, which we sell agricultural products into, buyers and sellers, they're often making decisions in long-term decision frameworks. It takes months for vessels to get from one side of the world to the other. What I bought last month, how much will that cost when it arrives? Will it be higher? A lot of these decisions typically didn't have to be worried about. But now with the changing volatility in US government trade policy, we're seeing a lot more confusion, uncertainty, and volatility in the market, and that flows through everything that's bought and sold in the economy. So we see this happen in real life, and the tariffs do matter in terms of where volumes go. So the best example I've seen of this so far is on beef exports. So we'll go with the beef example this time around. So the US, as we know, have a very strong need for imported beef from other countries, and Brazil's in an excellent position, just as Australia is, to sell that into the US. They were doing so at very strong values up until we saw the Liberation Day tariff added. So this was an additional tariff on top of what was already being given, and we saw volumes from Brazil into the US plummet. We saw further tariffs escalate to 86%. We saw volumes drop again. So even though the US fundamentally needs as much beef as possible from other countries, this policy stopped that trade happen at significant levels of volume. That meant that Brazilian beef had to go to other countries such as China, which we also compete into. So even though the Brazil and US trade policy decision doesn't really involve Australia at all, our agricultural economy, our exports and trade are impacted by decisions made about tariffs elsewhere. And the reason why that matters is we have been getting used to a world without tariffs since the 1990s. So removing tariffs, removing red tape has been the general direction of trade all the way since the 1990s. So it's a pretty big burden, the re-emergence of tariffs. And it just doesn't mean that exporters, importers are hurt on the bottom line, but mainly because all of the infrastructure investment in the last 30 years has been geared towards a world with more liberal trade. So we've had bigger boats, fewer ports, less red tape, which meant economies of scale. That meant cheaper transport cost, which allows greater access and in theory more value being passed on through the supply chain. So if cargo on an ultra container vessel needs to exit a port, but there's several different cargoes on there with different tariffs and it's got additional costs, this creates inefficiencies in that trade that weren't accounted for when people were deciding to build megaports, to build these gigantic vessels. And that means there's a lot of inefficiencies and rerouting and changing of what most people strategically would want to do when buying or selling goods overseas. So all of these big multi-million-dollar investments are threatened when we have changes to tariffs as well as non-trade barriers such as biosecurity and other things that happen. Now, we can't talk about the economy and about the big drivers of the market without talking about the conflict in Iran. And the closure of the Strait of Hormuz has had significant impact on input prices so far. So Middle East urea, free on board, spot prices are significantly higher than they were before the conflict started. And as we all know, the Middle East is a big source, a big area of urea being sourced into Australia. So higher prices, as well as uncertainty on whether the urea is going to be available at the time that growers might need it, are significant tailwinds. It also adds costs throughout the entire supply chain when we think about, right, what happens to a crop when it's grown. There's all these other different parts of the economy that are impacted by whether or not wheat is grown or not. So there's significant impacts from this that continue to flow through. And not the only one here, as you all know, impacted by higher diesel prices. It's a significant issue for the agricultural economy, particularly as we approach winter crop planting. So what we saw, the last energy shock with Russia-Ukraine conflict starting, was only a 15% month-on-month jump. So it's pretty unprecedented, the level of increase in price that we're seeing with diesel. Now there is, and we've seen with some changes that the governments have made, there is potential for some downside in prices. When we see Brent crude sit above $100 a barrel, typically diesel would average about 190 cents a litre. So as long as we have confidence in supply of that diesel coming through to the country, we should see some rapid downside once we're certain of that volume getting to where it needs to go, because historically that has been the case. But still, it's a big issue and it impacts every part of the supply chain, not just on farm, checking your water troughs, checking paddocks, getting ready for seeding, for running your spreader. All of those things cost as well, but it's the trucks to get product to and from places. It's the vessels and the planes that you require using oil and petrol and diesel to get from one place to another. It all adds to the pressure on the supply chain. So I'm now going to focus on the lamb and sheep market trends and drivers first that we're seeing. And fundamentally, what we're seeing is that sheep meat consumption is increasing in emerging markets. So that is countries such as those in Southeast Asia and in the Middle East, where incomes are beginning to improve and populations are beginning to rise. So that's really important for Australia and for the sheep meat industry to understand that there is this growing new customer base that want to consume more sheep meat than they already are at the moment. If we just rely on selling to only the US and only Europe and only the UK, they're probably not going to consume more lamb than they already are at this moment. They're probably, on a per person basis, going to keep doing what they've always been doing. But these countries where they haven't had access to this high quality protein before, they're the ones that are going to drive growth. And that's what this chart shows. Essentially, what we're forecasting to be the increase in kilograms eaten per person per year. So it's going to be really strong growth in these other countries that are beginning to become more industrious. And that's good because a lot of them are located close to Australia. The other key pivotal bit of information around the importance of these export markets is Australia's ability to capitalise on that growing market, because Australia's competition is seeing flock decline grow really rapidly. So the New Zealand and the US sheep flocks are in strong decline. And as you can see on this chart on the right-hand side, after being closely sort of correlated and following similar paths, we've seen a strong deviation of Australian sheep meat production increasing and New Zealand sheep meat production decreasing. So when we think about all the new potential customers buying lamb and mutton, Australia's in a really strong position to be at the front of the queue to sell that product. And that's going to be really important for the long-term success of the industry. Now, I've talked a lot about export markets, and when we've seen this recent boom in pricing over the last 18 months, it's not just solely because export markets are going well, but there was some really strong data that came out of the data we saw. So 2024 was the peak boom year for exports. We saw strong growth into the US. We saw really strong growth into the Middle East. What we've now seen is that prices have begun to rise. And we've seen the US, they're still really desperate for Australian lamb. China is buying a bit more Australian lamb than they were in 2024, which is good. But we've seen the Middle East drop away last year. and they will again this year, which I'll get to later. But fundamentally, some of these countries are a lot more price sensitive than others. So when I say that the future is about these emerging economies, it's important to remember that we can't just put all our eggs in one basket, because if drought occurs or the prices of sale yard lamb prices increase or decrease dramatically, that'll have a big impact on who buys it from us. When we think about exports and all this production that we're having. And we're starting to see that Chinese, Middle Eastern demand for mutton as well is starting to decrease. We have seen supply absolutely play a part. There's less sheep to kill, so there's less mutton being produced. But fundamentally, it's a bit too dear at the moment for the amount of volume that they were previously doing the last 2 to 3 years. We're also seeing with the implementation of the US tariff on sheep meat from Australia that there's also a bit of pressure there. So the flock decline, it's been pretty substantial due to the really strong drought pressure we've seen in the last 2 years in southern Australia. So the sheep flock is projected by MLA in 2028 to reach 64.5 million head, which would be the lowest since the end of the Federation drought around 1904. So that's a really significant level of decline that we've seen in the last few years. And that's largely been driven, by the prominence of grain and cattle production encroaching on traditionally sheep production areas. But in more recent years, that really strong drought pressure coming in the southeast. So the Victorian sheep production regions, they've had 2 consecutive years, 2024, 2025, where there was significant drought pressure. Land markings were poor, ewes were not retained, and with low wool prices during those seasons, the impetus to keep as many wethers on farm as there previously would have went down. So we saw a strong decline in numbers occur because of this. So for this year, the flock's forecast to decline again 1.7% to 65.3 million head. And what we're seeing is that there is really beginning to be a lack of supply at the sale yards compared to the last 2 to 3 years, which will have a bit of an impact on the market moving forward. So this chart on the right-hand side shows the eastern states lamb and sheep yardings. So for periods last year, we saw the green line much higher than the 5-year average and this year's levels. So there was still a number of stock coming forward, not as strong as we saw in 2024, but there was still above average levels for much of the year. Now, well and truly, we're starting to see that there just isn't enough supply coming through to the yards for processors and restockers that have had rain to purchase stock. So that's going to have a bit of an impact on price as we move forward, and the data shows that this is the case. So when the flock liquidation driven by the southern drought started in 2024 and through 2025, the processors invested in capacity and they made sure that they were processing as many head as possible. So that green line on this slaughter chart here, from January to June last year, we can see pretty strong levels of slaughter. It's much higher than the 5-year average and the 70% range. There's significant volumes of sheep being slaughtered at this period, both lamb and sheep, rather. But as we approached winter, and it was a second year of poor seasons, producers that had poor lamb marking, they were not able to move on as many sheep as they had. The turnoff had already occurred down south. And what that meant was, all of a sudden, they weren't able to process as much stock as they used to. There was a bit of an arms race to secure stock, which saw prices absolutely fly as we approached winter last year, shown on this Eastern States trade lamb chart here. Seasonality absolutely flying above the 5-year average levels, and up to this point, we're now at record historic high prices for this time of year. So it's been a really strong historic result, but a lot of that's been driven A, by the export demand, but B, that lack of supply being available and the processors having made that investment to ensure that they were able to be as productive as possible. They needed to find lambs and they needed to find them quick. So we know processors have invested in supply, boosted capacity. The season and supply made volume harder to source and prices tracked higher. We saw expensive feed, which meant land markings were poor, and supply moving forward is likely to remain poor in the very short term. So we do know demand's strong in export markets, but processors are no doubt feeling the squeeze, and there is more than enough uncertainty in the global marketplace at the moment to keep a lid on further price increases. So with winter approaching and likely less supply coming forward, everyone's instincts are that, prices will just continue to rise because we're running out of stock and they want them. But there is more to play here, and the impact of that will be pretty significant on the processors. Price upside's only possible if the processors are willing to pay more, or they can pass that on to export markets or domestic consumers. When we think about everything I've said so far, interest rates higher, inflation and diesel costs, your average city consumer at the supermarket probably unlikely to be willing to pay a lot more for land than they currently are at the moment. When we think about the export market, the land that they're getting is the same in the US, but there's now a 10% tariff on it, and the exchange rate makes that same product much more expensive than it was 2 or 3 months ago. So just how much more upside there is, it's probably unlikely to follow the same rapid increase again that we saw last winter. And we've seen this week in the national indicators that there has been a bit of pullback on price. So I've spoken about lots of export demand and that the US is a really important market, but we are seeing that sort of impact on volumes at the moment into the US. So 10% tariff, now due to a Supreme Court ruling, likely to turn into 15% tariff. The Aussie dollar is now higher, so we account for that additional tax on that price going in. We are going to see a bit of substitution begin to happen in the US market, probably towards more affordable cuts. They're still bringing a lot of Australian lamb and a lot of Australian mutton, but it's going to be the more affordable cuts as opposed to the more expensive restaurant service things that we've seen. We've also seen that due to the Middle East conflict, which I'll get to in a second, that the US is probably going to take on a bit more volume than it would like, and they're probably going to receive discounted prices for some of those initial March volumes that were headed to the Middle East. So what that means is the climate's been really, really strong the last 2 years to sell as much lamb as possible into the US, but we're still approaching that season and we're starting to get some headwinds pushing back on just these record prices we're seeing with lamb. And of course, the Iran conflict. So with the Middle East is a strong market for us. They prefer lamb to probably be a lot more affordable than it currently is, but they were still a strong buyer. What we've seen in March is because there is no air freight available, because a lot of these commercial flights flying into places like Dubai, Abu Dhabi, because they're not happening anymore, we're not seeing as much of that chilled lamb product that goes in the whole goes transported by those air freight vehicles, or those planes rather, into the Middle East. So we're seeing a significant decline in volumes into the Middle East. So we've got US being a bit sort of careful about how much they're willing to pay at these record prices, and we now have a logistics issue trying to get this product into the US. So into the Middle East rather. So there's a couple of headwinds that'll probably likely stop upside in prices as we approach through winter here again. And again, it's uncertain whether the airports will be back on, off again. It's difficult to ascertain. I'll move on to wool now. So we've seen in the last, as a result of that declining sheep flock, and as well as a lot of people moving on their wethers and their ewes from their breeding flock, that we've seen a big impact on the level of supply of wool into the market. So 22, 23, 24, these years here on the right-hand side, we saw a strong rise post-COVID era as more wool being sold on a week-to-week basis. We had a steep decline as a lot of that wool wasn't available, and now that has led to some really strong price results for wool growers throughout Australia, no matter what market they sell into. So that's really been driven by the lack of supply and not economic conditions improving in China and all these other economies where they consume luxury goods, which wool is largely considered. So buyers operating on a hand-to-mouth basis, the supply chain's used to a reliable amount of wool coming in each week, each month from Australia. And now that that supply is starting to dwindle and there isn't being stocks built up, they're now starting to have to bid against each other quite strongly. And that's been pushing up prices that we've seen in the last few weeks. Again, we do see a couple of big weeks, but fundamentally, we're struggling to push higher than the 5-year average levels when it comes to wool bales sold. And it's not something that it can get fixed straight away. Again, you need more sheep to get more wool in general. And we know from the flock projections and the conditions in the south that we're probably not going to see a lot of strong flock growth in the next couple of years. So the Australian Wool Forecasting Committee, they have a projection where they're thinking it's about 12 to 13% decline in wool to occur this season. So that means that wool volumes pretty much between now and the end of the financial year are 15% lower than they were last year. So all those words and all those numbers, what do they effectively mean? It means that it's going to be probably for the next 6 to 12 months, a reality that we're going to have less supply in the market, which will be supportive of prices. But is there even more upside potential from the prices we've seen currently? And from some of the work that Andrew Woods, the Mecardo analyst, is doing here, there is more upside that we can likely see, all things being equal. So the current wool market, if we just think about average merino pricing, it's up 79% in US dollar terms from the last low point that we saw in 2024. Typically, the median cycles, so the price cycle going from a low point to a high point and back down again, it nearly takes about 2 years and 23 months from the lowest point to the highest point. So currently what we're seeing with prices is in line with this modeling. So what we're expecting is for prices to continue to rise over the next 3 or so months as we move through this period of low supply and higher prices. Now, that's really good news for wool growers, considering the amount of years we spent with the wool market in that sort of low period over the last couple of years. But fundamentally, it shows that the market is still reactive to changes in supply and the flock, and we're not just producing a minute supply of a product that has a niche market. The market in general still requires wool. It still requires a strong amount of that, and it's quite susceptible to supply still, which is good. So we also have this issue with oil in the Middle East and Iran. And as we know, oil is the key input into creating synthetic fibers. So we're seeing a really strong increase in synthetic fiber prices, which is now helping to offset any potential weaker demand for wool that we could potentially see because of a high Aussie dollar or because of issues with getting stock from one part of the country to the other, or inflation, or all these other reasons. So even though wool's more expensive for a Chinese buyer to buy because of the Aussie dollar, all of the other things, all of the competitors are also higher because of this at the moment. And that's really important for the long-term sustainability of this price rise. So 30% rise in annual average oil prices would typically precede then a downturn in lower merino wool prices. So what that essentially means is that if we see a long-term 6-12 month period where the Iran conflict leads to really high oil prices, no matter what we talk about with strong supply, with weak supply and a strong Aussie dollar, we're going to see that downturn probably occur again. Unlikely to get to the levels that we saw prices at 1 to 2 years ago, but to suggest that wool prices are going to just keep going higher and higher and higher because of the declining supply, that wouldn't be necessarily what we would suggest is going to happen. We haven't seen any data that suggests that the freight costs because of higher diesel will have an impact on Australian wool heading to China. But again, that is something that we're monitoring on the Mecardo website pretty frequently. Also talk very briefly about RWS premiums. So we've seen in recent analysis in the data that we're seeing really strong median range level of premium across whatever micron group you're selling. So this one's more at the merino side of things. So if we're looking here, this chart's essentially micron group at the bottom, and then the median premium that like type wools would get. So that's assuming very similar VM content, all that sort of thing. So we're seeing that because there's a really strong rebound in the wool price, this is also translated through to RWS premiums. Buyers that want this type of wool are willing to pay more for it at the moment compared to similar wool without that accreditation. So the most important caveat when talking about RWS premiums is that the underlying quality of the wool still matters. So if it's not the most accurate, accurate's the wrong word, if it's not the highest quality wool and it has an RWS certification attached to it, it doesn't necessarily mean it's going to attract a strong premium. And when we do see a downturn in the market, we do see the RWS premiums go down as well. So it's not exactly a fail-safe lock in a premium and a boosted premium for your returns on your wool. But fundamentally, when the market's doing well, we see RWS premiums also do very well on the on the premium side of things.
Ethan, 5 minutes.
Perfect. So what's ahead for markets? Effectively, we're going to see tight sheep meat supply, and that should be supportive of export pricing in the long term. So those really high prices we're seeing at the moment at the sale yards, that's probably going to push prices down in the shorter term when we see a bit of a roof on the US willingness to pay, as well as issues of getting product into the Middle East, as well as China's price sensitivity. But fundamentally, the laws we've seen with economics is that this growing demand for Australian product and tighter supply with less US and New Zealand competition is going to be really supportive of prices in the long term. We know that protein demand in Asia and the Middle East is growing, and despite issues getting it there at the moment with fuel and vessels being stuck in the strait, fundamentally there is going to be strong protein demand moving forward. Of course, avoiding recession in China is key to supporting every commodity market, particularly those in Australia. But when we think about wool and mutton and all these other products, if they're price sensitive now, if there's a lot of economic pressure because of a downturn or anything like that, that would again flow on through to those markets here in Australia. Wool price upside is still likely, and sale yard lamb and sheep supply will have to probably track downward again. We're not going to see a flush of stock come through. That would have already happened with the record level of prices we've seen already. So fundamentally, we're probably going to see a bit of an adjustment on the demand side and the processing side if the level of supply continues to remain quite poor. The better southern season should support marking rates. So we should have a much better lamb crop in terms of quality, weight gain out of the south than we've seen in the last few years. But again, that all remains on the forecast seasonality wise coming forward. And the tight supply will limit strong downside. So while I've said a lot today about how the ceiling on the US lamb export price and the processors being concerned about how much they're paying for lamb and sheep, and that will likely put some downward pressure on pricing, because we still have these strong export markets fundamentally, we shouldn't see really strong dramatic decreases in pricing because there will be a bit of a support bubble there as we approach a lower price. And that's really important for the long-term sustainability of the market as we move towards this sort of lower sheep flock projection that we're seeing over the last couple of years. So just to wrap up from me before we get to some questions, this is a QR code to subscribe to the Mecardo Market Insights. So it's an email that we send out twice per week with the articles that are available on the website. This used to be a paid service, of course, but it's now free under Nutrients. So what we do is email you the articles about commodities that you're interested in. So if you're running cattle, if you're putting a crop in as well, we're covering that. But yeah, fundamentally, what we do at Mecardo is focus on what's happened, what does it mean for farmers, what does it mean for Australian agriculture. So I will put this one on board, but that's pretty much all from me. And I'll put this one back up again shortly. I'll just go to read the questions if they're already popping up. But yeah, that's it from me for the moment.
Okay, thanks, Ethan. We have a few questions that come in before the webinar. The first one is, a few years ago, Robert Herman, in an earlier webinar, talked about a new higher permanent price for land, that we move from one plateau to a higher plateau. Are the recent higher land prices establishing another higher permanent price level? And the key word, I suppose, is permanent.
Permanent? So permanent's a funny word, but fundamentally the prices will be higher in the long term than they have been. So that plateau framework that Rob talks about is correct. I like to think of it sort of as a staircase. So you have periods where it'll be high, it'll go higher, then we'll see it drop down again. But where it drops down to will likely be higher than it was in the previous 2 to 3 years. That's assuming average seasonal conditions, etc. But what we've seen with prices, and I'll just get my slide back up again where I've got this located, because I think this is the best way to show it. Let's go back here. Sorry, I'll click through. That's probably the quickest. So as you can see, pretty much from this period here, 2023, and you think about April 26, where we've been now, we've gone through a period of lower processor capacity to higher processor capacity. We've seen the Middle East not be in the export market to back in the export market. We've seen drought in the southern regions, and we've also seen a bit of rain come back on board as well. So all of this time, we've seen prices track marginally higher year to year, and they're now at the period where we're seeing these really strong prices here. Now, to say that the trade lamb is never going to get below $10 again, I wouldn't say that. But fundamentally, when we think about where we are in 3 to 4 years' time, it's more likely that this upward trend is likely to continue in the long term. So yes, that is the case, and that is because there's more demand for sheep meat globally, and there's less supply currently at the moment in the last 2 to 3 years. But even if we see the US and New Zealand flocks increase dramatically, we'd still be in a position where that demand's probably going to outpace the supply, which will be supportive of pricing.
Aaron, you have a question.
Yep, we have got a question come in. I'm just reading it out. What advice would you give someone in relation to getting into wool or meat production who has a high turnover goal in mind, piggybacking off the saying, when everyone else is running, you walk, and vice versa? How would you value walking, that is, not selling stock in a hot market, or running, selling stock in a hot market?
So there's a lot to that, and I would say that particularly for sheep producers, that and we've seen this during the drought down south, that a lot of producers wanted to take advantage of the higher prices, even though they didn't have the feed on hand in pasture. So they did move towards that lamb feedlotting sort of setup in their yards or in a paddock. And if we're talking about high turnover methods, that's a pretty great way of doing that, because fundamentally you know your cost of production in terms of the cost of your grain to get kilograms onto your lambs, and fundamentally you're probably going to have a grid price or an indication from your agent about what the likely price that you're going to receive for a certain kilogram target weight that you're going to get to. So when you're working on high volumes, you're probably requiring pretty consistent turnover to keep the money going, as well as a really consistent goal and a buyer who has a specific need in mind that's willing to either pay a contract or do some sort of back and forth with you. So that, not saying that everyone should get into lamb feedlotting, but fundamentally, if you've got your cost of production and your ability to deliver a product in a set time, you can then start to plan ahead, because if you buy lambs today and then in 3 months' time the price is much lower and you're only recouping your costs, you want to make sure that you're getting absolute bang for buck in terms of specs that that buyer wants to see. And fundamentally, while zigging while others zag can be beneficial, at the end of the day, you got to do what you can do best with your property. And whether that's to buy more ewes to have more lambs for the upcoming spring crop next year or something like that, that might be the best use to think more long term, or to increase your breeding stock now. So when we do know that supply is going to be lower in 2 to 3 years' time, you can capitalize on those higher prices at that point, instead of potentially just chasing the prices that we're seeing currently in the market, by bringing stock on, bringing them off with higher diesel costs. Like if you bought lambs in, or planning to buy lambs in February and went to the market in March, it would again cost you a lot more in diesel to get them there and to get them and to get all your other inputs in. So yeah, that's probably food for thought there.
We have another question. Thanks, Ethan. Are there any figures available that compare wool returns from auction and electronic sales? If there are differences, where are they?
So a lot of the data that we use comes from AWEX. So they do excellent market reporting from the half micron group all the way through, from your super fine all the way through to your crossbred. So depending on the wool that you're after and how frequently it's sold, we'll have better clarity of information there. So that they're the data partner that we rely on to get as much information as possible. So yeah, that's what I would suggest. There's a lot of good information there, and to also talk to your local broker or anything if you've got a specific product that you're trying to sell, micron, and you know what your clip's going to look like, or you want to make the most of that and not be captured in and missing out on potentially a good week or a bad week. That's probably the way to go. At the moment, things are very volatile in the global marketplace, so the transparency of finding out how much your clip would have sold for one day or the next, it changes so quickly at the moment that yeah, it's good to ensure you've got some, I guess, other stakeholders that you can fall back on for some advice, or at least some transparency about what they're seeing.
Thank you. We have another one about sale yards. A few years ago, Mecardo reported a comparison between sale yards and came up with a range of conclusions. One of them was basically the bigger the better as far as returns were concerned. Is the comparison to be repeated? And if so, can Warwick, as the only sheep sale yard in Queensland, be included?
So yeah, if that work if we were to revisit that work, we'd definitely include Warwick. But I think probably an interesting takeaway that we've seen as a result of this current market we've seen in the last 9 to 12 months is that a lot of people would suggest that just because Wagga as a sale yard gets a lot of the big buyers, that's where the most important market in the country is. So try and get your lambs there no matter what. But we have seen that due to what offering is available on a week-to-week basis, that there's definitely buyers willing to travel and willing to chase rainfall and places that have had good growth, to look for the article of lamb that they're after. So when we're dealing in a market where supply is starting to tick lower and there's a lot of variability in season, just having a bigger sale yard where all the stock can converge on, as opposed to being able to go to your geographic locations to chase the article you're after, that if we revisited those numbers again, there's probably some different insights that we'd have to take from that. But yeah, to suggest that there's only going to be a couple of big only sale yards in the next coming years is probably not the case. We're likely to see that no matter what, there's going to be the more sale yards there are, the more opportunities there are for different geographic spots to take advantage of the stock they're selling at that time.
Thank you. Aaron, did we received any other questions, or have you received any?
I have one just here. So recently, a small increase in the wool price was celebrated by many industry pundits, but concerns were expressed that the increases seen were too big and happening too quickly. The price increases only changed what were very poor returns from wool to poor at best if sheep sales are not included. Where do these comments come from?
Well, again, it depends on the information they're looking at and the data they'd suggest, but a lot of people want to react very quickly as soon as a rapid change in price occurs. So whether it's higher, shoots up really, really high over a 2-week period, you all want to say, oh, this might be unsustainable, or this isn't good, or what's going to happen next. But as we say, the cure for high prices is high prices, and if we look at these things over a more longer term basis, you'll find that probably a lot of those people that would initially say something like that, they'll probably see that as things normalize, or we see more stability in the supply levels or in the demand levels, or whatever it is that's driving the market at that moment, that those probably those critics of what's happening in the market at that time probably change what they're thinking. So again, it's being an economist and being someone who watches the market, so it can be wrong a million ways and right one way, and it all just depends on what different people say is what information they're privy to. So we like to focus when we've got data that we can speak to make sure that when we're making an insight, that it's coming from a position where we've got these numbers that are transparent, that and a lot of people could get to different conclusions from the same data set.
Thank you.
Thanks, Ethan.
A fairly easy question. What's the normal percentage relationship between sheep and lamb prices?
Well, if we think about it, the sale yards, the spread, so the difference between trade lambs up to mutton, so you turn off a cull sheep. When supply and demand's normalised, it's about a 20 to 30% discount. When we saw the processors begin to invest capacity, the mutton discount was at 80% compared to trade lambs. So that meant that mutton was good buying for the processors. We also had a period of time there where the producers were really keen to get rid of a lot of this excess stock, get rid of these cull sheep, and we've seen that the spread has begun to really rapidly rise back to that level. So we're currently roughly at 28 to 30% discount at the moment. So there's probably not going to be too much more upside on the mutton price if lamb prices stay the same as what they are. But yeah, fundamentally, we're seeing that. And when you look at the spread data, it's pretty clear to see when buyers can see the opportunity. And yeah, it was pretty monumental, the discounts that we saw with mutton when we had that El Nino talk in 2024, when mutton was getting really, the prices were getting really, really low. The opportunity was there because of the spread, and that ended up being higher capacity, led to higher prices when supply normalized.
The next question might be outside your field of expertise, but why does the MLA report sale yard lamb and sheep prices in cents per kilogram carcass when the live weights at most sale yards are recorded and measured? Buyers are guessing, and I'm sure it's an informed guess, at dressing percentage. Cattle are always reported and sold at sale yards on live weight. Why the difference? Is there a biological reason, or is it just tradition?
Well, I think one more for the MLA on their methodology there, but I think from an economist point of view and someone who looks at the market, having it in cents per kilo carcass weight allows us to more easily understand and analyze the cost of that input, which is your lamb that goes into your final processed lamb that's sold onto an export market or onto the domestic market. So from a market analysis point of view, that's what makes sense. As opposed to, and again, doing the calculations when you're in the sale yard in the heat of auction, again, that's necessarily not the easiest thing to do the conversion in your head straight away. But fundamentally, what I would say is that because of that and because of the lack of variance with cattle, they're sold in a lot wider weight range than they are with sheep, that there is a bit more of a story to tell there on that live weight percentage, whereas on the sheep front, it's pretty consistent in terms of what your carcass weight ends up being.
Okay. Aaron, you got any questions come in?
Sorry, I think that's it. I haven't got any more come in.
Okay, well, I've got one more. And it's a question about merino lambs. They're often sold at lower prices per kilogram. Carcass shape, or how they hang, and lower carcass yields are often quoted. Can you comment on that?
Or I guess in terms of what the buyers want at that particular stage of time, if we think about where those lambs are going, particularly if they're and also depending where they're sold, if they're not heavy and higher framed enough like they are with those export lambs that we see with crossbred lambs in the market, they're not going to the US market, which is the highest value. So if they can't pass that higher cost on through to the person buying at the other end, then they'll have to pay less for that at the sale yard, which is what we see with merino lambs at the yards. But again, it's not just a simple, there will always be a discount. So depends what's happening with wool, depends what's happening on farm. If producers are opting to choose a merino lamb for whatever reason they want to choose over a crossbred at that time, or whether they're just wanting to maximize numbers and they're the best lambs at the yards available at the time. All those factors play into it as well. But fundamentally, it's what the processors want in terms of being able to sell that article onto the end customer and what that end customer wants in their demands are. Particularly in those export markets into the US and the EU and those high value markets, that those crossbred lambs perform better on the weight and the marbling scale. But that's not to say that there isn't going to be a strong growing market for merino lambs in the future. So it just depends what the producer wants and what the buyer wants at the end of the day. Again, whether there's an opportunity with wool continuing how it's going and producers want to buy merino lambs, bring them back on farm because they want to eventually grow that wool and then turn that stock over later and they get that value on the wool side. Just depends on what's happening in the market at that time.
Okay, thank you, Ethan. In the absence of any more questions, I'd like to thank you for your presentation. I'd like to let people know that it will be on the Leading Sheep website in a couple of days. Thanks to Aaron. I'd also like to thank Robert Herman, even though he couldn't be here tonight, for his input in the planning of this webinar. And I'd like to thank the audience. One of the things that I use a measure of how interested people are in the subject is how many stay online for the entire time. And we've set a new record. The dropout rate has been very low and it's only been in the last minute or two. Don't forget to let us know what you think. You have 3 options available. One, you'll receive an evaluation, and I hate using that word, either immediately or by email probably tomorrow, or you can scan the QR code that Aaron is going to pop up now or very shortly. And Aaron looks surprised that I suggested that.
So I think I got on my one. Here we go.
Okay, so thank you everyone for your attendance. Thank you for your participation. Thank you, Ethan. Really appreciate it. This is about the 5th time, I think, Mecardo has provided this webinar for us. So we really appreciate it. And please let us know what your opinion is. We do value them and we do use it. So good night, everyone.
Thank you, everyone, and best of luck for the rest of the season.